What is a liquidity trap in an economic depression? Imagine a time when even with all the money a central bank creates, people and businesses refuse to spend or invest. That's what a liquidity trap looks like. It happens during a depression or severe downturn when interest rates are at or near zero. Normally, lowering interest rates encourages borrowing and spending. But in a liquidity trap, that no longer works. People prefer to keep cash instead of investing or buying things, even if borrowing is cheap. This situation often appears because of widespread economic uncertainty or fears of falling prices. When people expect prices to drop, they hold onto cash, hoping to buy later at lower prices. Businesses see little demand and hold back on investments. Consumers cut back on spending, fearing worse times ahead. Because of this, even if the central bank increases the money supply or lowers interest rates, it doesn't boost the economy. The extra money just sits in people's hands or bank accounts. A key reason is that interest rates cannot go below zero. Once they hit that zero lower bound, the central bank cannot make borrowing any cheaper. So, traditional monetary policy loses its power. Despite efforts to stimulate demand, people and companies remain hesitant to spend or invest. This leads to slow or no economic growth, and the depression continues. Deflation, or falling prices, makes things worse. When prices drop, the real value of debt increases, discouraging borrowing. Banks also become cautious, reducing credit availability. During a financial crisis, banks may even fail, making the situation more severe. All these factors combine to trap the economy in a state of stagnation. Historically, episodes like the Great Depression in the 1930s and Japan's long recession starting in the 1990s show how a liquidity trap can keep economic activity sluggish. Even with very low interest rates, demand stays weak because people and businesses prefer holding cash. In simple terms, a liquidity trap is when monetary policy stops working because interest rates are at zero, and everyone hoards cash instead of spending or investing. It's a tough situation that can keep an economy stuck in a slow or declining state for a long time. To get out of it, governments often need to step in with fiscal policies like increased government spending or tax cuts to boost demand and help the economy recover.